But as you touched on earlier, we don't have the experience. And so everything I'm buying is going up. JDSU, Sun Micro, you buy the stock, it's up the next day. Oh, my portfolio's up 60,000 from yesterday. And again, these aren't high wealth individuals, okay? These are just engineers like me making 70, 80K a year. And yet their portfolios are going up more than their salary in a day. Every stock I buy goes up. Life is great until March. I YOLO'd almost my whole account on calls because every earnings, the stock would go up 5-6%. After earnings, it went down 8%. I'll never forget. Pre-market, it was down 8%. My calls opened at 3 cents. I lost my whole account, blew the whole thing out, pretty much. If that happened today, I think people would just go totally, they'd be jumping out a window.
Hey everyone, Sergio here. Today I'm joined by John Moser. I met actually John on X, the old Twitter. And over the past few months, we started following each other, and I tremendously enjoyed his posts. And so he's gracious enough to join me today for the Insiders. And I've interviewed Jack Barugian, I've interviewed Anthony Crudelli, and John is the third OG, I call it. We're all OGs. We've done this for a while. So the reason we're doing these is because, we want to pay it forward. We want to, teach people how dangerous trading could be and educate and inform people. So John, welcome.
Thank you, Sergio. It's a pleasure. Yeah, it's great to connect with you on X, especially someone who's been in the trenches as long as you have. And it was like a breath of fresh air when you came to one of my spaces and you started talking. I'm like, I got to get to know this guy because you've been in this business a long time. And when you've been in it a long time, you pay your dues to Wall Street, your tuition, essentially. And that's really something people can learn from, that this is not an easy business. And those who say it's easy haven't been in it long enough. So Great to be here today with you.
Thank you. I appreciate it. And the thing, I had wonderful mentors when I first started, and, they always used to say things that have stuck with me for all these years. And then I'm sharing them, on my YouTube channel with the viewers. They said, you can read the best charts, you can have the best computers, you can have the best software, best tools, but they said, you cannot buy or teach experience. You have to do it. And that's priceless. And you do have plenty of that. So go ahead and introduce yourself, your career, what have you done before trading, how long you've been trading, all that good stuff.
Yeah, well, how this all started, at least my interest in trading, goes back to my father. So my father never finished 8th grade. I grew up on a farm, and he had a mason contracting business. I don't think my father ever slept because we had the farm to take care of. Plus, he did this masonry work to bring in income. And I used to help out as young as, I guess it was like 7 or 8 when I started helping, carrying bricks and things like that. But what I noticed is around 4 o'clock, my dad would always go into his pickup truck if we were at a job site, and he would turn to Business 1060 AM and then out of Philadelphia. And we would hear at 4 o'clock, today, the Dow Jones Industrial Average closed at 922. There were 19 advancers on the big board. And that's how the guy talked. And I'm like, Dad, what's a big board? What's the Dow Jones? Like, what is this? How come every day it's different? It's 920. You can date my age here, right? This is in the 70s. And my dad, who really didn't know a lot about the markets, was just fascinated with this thing called the Dow Jones Industrial Average. And he told me, he's like, son, it's an index where stocks are traded. And, he kind of knew some of it. He never traded himself, but I got fascinated by this, like I said, around 8 or 9 years old. And so I always kind of followed the markets when I was a teenager. And then I went on to do undergrads in business, undergrads in biology, and then went into biotech on the business side. I wasn't smart enough for the science side. So I was on the corp ops side of things, basically where the CapEx and OpEx was being spent. And then I did my master's in economics at Johns Hopkins a little later in life. Started trading actively mid-90s-ish. The old days where you called the broker, right? I didn't have any online platform. I didn't have a Bloomberg terminal, all those things. So I had Smith Barney was my first broker. Yeah. You remember those days you call them up, and there's no day trading with a broker because you're on hold. The prices are changing. You don't even know what the price is because they're 20 minutes delayed in those days. And so I think it was 99 or 98. I got my first TD Ameritrade account on a desktop, which was like, wow, I can trade myself now. I don't have to call the broker anymore, right? So I would say I got really into trading from a serious trading standpoint right as the dot-com boom was maturing in 1998. So that's when, things were just, full boom. As you know, you were trading at that time. And, and then 99, I mean, it was, for me, everything I bought went up. I didn't know what a bear market was. I mean, I knew what it was from what I read, but I never traded through one. And there's a difference, right? Yeah. We can have head knowledge, but as you touched on earlier, we don't have the experience. And so everything I'm buying is going up. JDSU, Sun Micro, you buy the stock, it's up the next day. And I'm like, this is great, wow, right?
Just like now.
Yeah, I mean, it was just a crazy time. And I was living in Palo Alto, California. I go to work every day, and I was in a biotech company, and people my portfolio's up 60,000 from yesterday. And again, these aren't high wealth individuals, okay? These are just engineers like me making 70, 80K a year. And yet their portfolios are going up more than their salary in a day. So you remember, it was just a crazy time, and I got caught up into it because I'm living in Silicon Valley. Every stock I buy goes up. Life is great until March. And I'll never forget this. In fact, I just told this story to someone yesterday. It was April of 2000. Brocade Networks. Do you remember them?
Oh, yeah.
Okay. I YOLO'd almost my whole account on calls because every earnings, the stock would go up 5-6%. After earnings, it went down 8%. I'll never forget. Pre-market, it was down 8%. My calls opened at 3 cents. I lost my whole account, blew the whole thing out, pretty much. Yeah. So that was like the pivot of, you don't know what you're doing. You have no clue what you're doing because you clearly were just caught in euphoria for the last couple of years. And then I learned what a bear market was.
Yeah, that's the thing, right? So, there are a lot of comparisons between now and, the GFC, obviously, the 2000 dot-com bubble. I remember those days. I was on the trading desk, and we'd be like laughing at people, because we're a profit center, right? So the orders would come in. Obviously, you're front running those days a lot. And I'd be like, these people are fools, man. This is going to be going so badly. But then it was the greater fool's theory, right? So I'll just buy it today. Some other fool will buy it at a higher price from me tomorrow.
That was like JDSU. I mean, it runs up to 1,000 in February of 2000. It was like 2017 was its peak. And then it's a perfect parabola. And then it just started to go lower and lower and lower. I mean, no one could deal with this. And I remember going to work then, and everyone's just pulling their hair out. What's happening? Why is this happening? Yeah. And just, the Qs dropped 20% from that third week of March of 2000 to early April. I mean, 20% drop on the Qs in 3 weeks. Yeah. If that happened today, I think people would just go totally, they'd be jumping out of windows. So from there on, so from that was sort of, as I say, you need to pay your dues to Wall Street. You have to pay your tuition. And I paid my tuition in the 2000, 2001, probably into 2002 before I started to really figure out, okay, this is how a bear market works. And then, of course, we bottomed in 2002, and then we had the bull run into the GFC. I did a lot better through that time period. I didn't get the top. I mean, I didn't sell everything in October of 2007, but I certainly knew when things were starting to shift. I saw the lower lows, lower highs. I was able to do the technical analysis, which I didn't do back in 2000. I was certainly not adept at it at that point. And so that I did a way better during the GFC. In fact, the GFC was great for me. I mean, it was one of the more profitable times in my trading career, actually.
Well, you knew what to do.
Was that? Yeah, because you knew what to do. Exactly.
Yeah, another advice I have received from my mentors is that, market goes up the stairs and takes the express elevator down. That's what's happening, right? So, but now you were prepared. You had history behind you. You had seen it. You had seen the movie before.
Right. In fact, I just shared this with someone yesterday. There's only 2 times in my, I guess it's been almost 30 years now of trading that I called a top and a bottom. So you figure that's not too often, twice. And one was the bottom. So I was washing my car on March 9th, 2009, and I had an iPhone, first generation iPhone, and I'm looking at the S&P. And at that time, it was in the afternoon, it was like 670. And I ran in the house, got on my desktop, my TD account, and bought every stock I could with every dollar I had. I bought Ford for $1. I bought Citigroup for like $2. I bought Bank of America. I knew we were, I mean, the NIMO, the McClellan oscillator, all these things were screaming buy. And I just was buying as much as I can. That's the only time I ever caught the bottom, that was the bottom, March 9th. We closed at 666 on the S&P that day. And so, it's people who say it's easy to do. It is not easy to call tops and bottoms. I think it's a fool's errand. I got lucky that day. And then the other top I caught was February 19th, 2020. But that was because I was working for Gilead Sciences at the time.
Okay.
And so we were getting remdesivir all over the country. I'm looking at the CDC data. I'm like, the market's not responding, but it's going to. And I just happened to one day go, this is it. The 19th, like this is it. We're topping out, which was that was a day the VIX, that was a VIX OPEX day. It was a Wednesday. And then, of course, the 20th, we had the liquidation break. And I'm like, that's it. We're done. Time to go short. So that's 2 times in 30 years, one top, one bottom. It's not easy because I see these folks on FinTwit saying, oh, yeah, it's really easy to call tops and bottoms. Just draw this line, do this momentum indicator. No, it's not.
Whoever says I'll buy the bottoms and sell the tops, run the other direction.
Exactly. But, so that's kind of been the history for me. So as a trader, everyone has their niche, right? Everyone falls into their rhythm. I only trade essentially 3 things. So I trade SPY, long and short. When I say long and short, I mean calls and puts. I don't actually short the index or short the ETF. I do go long the ETF, but I don't short the ETF. I do buy puts on it. And I play Dow futures. I've been trading Dow futures for 8-9 years now and love it because as I was explaining to Anthony Credelli, the reason I like Dow futures is there's just less variability. You're only dealing with 30 companies, not 500, not 1,000. And I have found it to be a much more, and I hate to say this, predictable futures contract to trade than NQ or ES or any of those.
Well, those Dow futures, Dow futures don't have them, or Dow futures or ETF doesn't have 0 DTEs either. So
correct. I mean, eventually
you may have an edge there. Yeah, you may have an edge there. Yeah.
And then I once in a while I'll play VIX products, SVXY, UVIX, and a stock here and there. Like I did Oxy calls a couple weeks ago. They ran.
I saw that.
And I sold early. I sold at 800%, and they went up to 1,600%.
Well, at 800, I'll take 800. I'll take 80% every time. Forget about 800%.
Greed's a killer. Bears make money, bulls make money, and pigs get slaughtered.
Exactly.
It's in a movie somewhere.
So why?
So that's kind of been it for me.
So let me. I was going to ask you about the macroeconomic conditions, but then we'll hit that next. But since we're talking about you calling the bottoms and tops, right? I mean, look, you have the record, right? And I'm like, to me, I honestly I trade what's in front of me, and to me, it's like I can't call a top, I can't call a bottom, but what I can do is once that's established, a trend is established, and I don't have to catch the 100% of it. I'll just miss 20% from the top, 20 from the bottom. I have 60% in the middle. That's plenty for me. So I'm with you there. So let's talk a little bit about
30 years twice. So people who say they can do this over, and it was luck. I don't even really think there was anything.
They try to do it every day. They try to do it every day, trading day trading, right? I'm like, it's impossible. But let's talk a little bit because I see your tweets. I follow you obviously. So please go follow John on X or Twitter. I keep saying Twitter. I don't know, X.
I wish he would have kept the brand. It really kind of works. X just doesn't work for me.
So you're at Market Sleuth, correct?
Yeah, Market_Sleuth, which is the reason I chose Market Sleuth, SLEUTH, is because what I do, my kind of niche is I look at past patterns that have occurred repeatedly in market history. And of course, we know as technology changes, the market changes. So we can't go back to 1960 and compare to today. It doesn't work. But we can compare early 2000s. I mean, we had derivatives then. I mean, things are a little bit different now, right? As you were saying earlier, 0 DTE and some of these other things that are happening. But the markets in the last 20, 25 years are fairly similar. You can do some analogies there. But it's not just that, it's also the human behavior piece repeats over and over and over and over. And that will never change. So human behavior is what it is. We respond with our emotions, and recency bias is the same now as it was in 1929. Okay, so I tend to use those things in my toolkit, in addition to the technical analysis and all the other things that are out there, which some of these things like the gamma and the charm and all this stuff and the Vanna, okay, it's just not my thing. But I do see value in looking at flows into certain things, looking at negative gamma, positive gamma, some of those newer, they're not really new, but they're new to me because I'm old school, right? So I'm a guy who typically trades with a 10 DMA, a 5 DMA, a 200-week moving average, and a couple momentum indicators and volume. That's pretty much my bread and butter. But
we're identical. We're twins on that one. We're literally twins on that because I love naked charts, right? I see charts, but I try to help people. They have like 50 lines. I'm like, what are these? I just don't even know what you're doing.
I know.
But keep it simple, stupid is my motto. And believe it or not, even with all this technology and the speed that obviously is increased exponentially, that still works. Just keep it simple, stupid. It's okay. Don't get, you don't need to be a jockey on a horse every single day, or, at a track, like a jockey rides 9 horses. That's what people do these days. It's just get on one horse, off on another horse. How many races you're going to win, you think, right? So, but, you eloquently tweet about the similarities between 07, 08 periods and today. Right. Mm-hmm. So for a few minutes, let's talk a little bit about that. What are you seeing? What are your tea leaves telling you?
This kind of popped up over the summer because a lot of folks were comparing the euphoria in the market and these new all-time highs every day. I think we've had 44 new all-time highs in the S&P this year, which is unbelievable, to 2000. And I said, no, I traded 2000, 99, 90. This is not like that. It's just maybe I would say late 2021 was more of an analogy to the later part of the dot-com bubble. And even that wasn't quite it. And you traded it yourself. But what I started to notice was there were some similarities that were just kind of, I found intriguing. So as time went on and we got into September, and then when we had the rate cut on the same day, they just started to line up, which I want to make this point really clear. This has nothing to do with we're going to have a GFC 2.0. No, it has nothing to do with a great financial crisis coming. No, it has to do with some things. Just how often can these things keep occurring and the outcome not be different in terms of a pullback in the market? So I'm going to rattle off a couple of them. So in 07, the market started to fall in mid-July, and it fell about 10%. I'm talking about the S&P. Throughout all this discussion, I'm speaking S&P. It bottomed on August 15th of 07. It was a 10% drop, and then rallied all the way into the Fed pivot, which was on September 18th of 07. It was an expected pivot. At that time, Bernanke was already giving all the signals, we're going to do a cut. Was it going to be 25 or 50? That's what all of us traders were waiting on edge for, right? And so on the 18th of September, they cut 50 basis points. Well, what happened that day? The market rallied another 2%. But what else happened? The 10-year yield went up. And the 10-year yield continued to go up into October. Sound familiar? It's been doing that. In fact, if you go back to September 18th of 2024, that's when yields bottomed. Yields been on a tear, 12%. TLT has been falling ever since September 18th. So that's one of them. If you look at the LEI, so I'm talking about the leading economic indicators, building permits, housing starts, all of these things are literally a mirror image. If you line the charts up and just look at the changes in the LEIs as you went through the first, second, and third and fourth quarter of 07, it's a complete mirror image of what we're seeing now. Also, delinquencies on mortgages 90 days out, FHA, mirror image. Delinquencies on auto loans 90 days out, mirror image. And let's look at equities. So in 07, the market, like I said, went up 2% on the rate cut day. We went up the day after this time on the 19th of September. We went up about 2%. And the S&P's been making new highs pretty much ever since. Well, in 07, On the 9th of October, which was yesterday, is when the Fed meeting minutes were issued, and there was a rally that day, and that turned out to be the closing high on the S&P. It actually had an intraday high on the 11th, which was a bearish engulfing candle, and then it closed lower. What happened yesterday? We had a new high on the S&P.
Yeah.
So you start to look at it, and you have to start scratching your head a little bit, going, what are the odds? Okay, you start from a pure statistics standpoint, which I did in my graduate days in economics. It starts to get a little funky. Okay, you can't just ignore this as chance. And then what's kind of interesting is someone said to me today, well, what if tomorrow we have a bearish engulfing candle and a new, all-time high again on S&P? I'm like, that's just going to be too freaky. So what does this mean? Well, in my opinion, especially with the yields rising, and then, here's the other one, gold. I forgot to even talk about commodities. They're a mirror image as well. Gold was on a tear from the rate cut in 07, and it peaked in March of 08, the price of gold. What's been gold doing since the rate cut? It's been on a tear. Commodities, same thing. So what does this all mean? Well, one thing I mentioned on Twitter is, we didn't know, in 07 what was going on. We thought things were great. We were still at new all-time highs in October. There was no crisis. I had someone tweet to me, it was an economic crisis. No, it wasn't. You weren't living there unless maybe you were in middle school or in diapers. We were actually loving 07. We were bullish. We were making lots of money. There was no crisis. The crisis didn't happen until later in 08. And by that time, Bernanke still didn't admit there was a crisis. He was still saying soft landing. You just go Google this. In fact, the NBR didn't admit there's a recession until December of 08. So third quarter 07, fourth quarter 07, we're like, nothing's wrong. They're going to do another rate cut, which they did on Halloween of October of 07. And the S&P and the Dow did not make a new high, but the Qs topped. Well, they topped for the year. They didn't top all-time highs because they were still cut in half from the 2000 bubble. So you add this all up, it's really staggering. I mean, now again, if we get new all-time highs in the S&P on a closing basis, we could just toss that out. But the whole thing with the 10-year and the way it's correlating with equities, and I'm talking about the S&P, is to me kind of interesting. I can't just ignore it.
No, it's a mirror image, but if it's so obvious, though, it most likely it will not happen. But because everybody's looking at it, but market is a mechanism to make everybody wrong, right? And everyone that's looking at it, it's like, it's a mirror image. I'm like, Although I must agree, a lot of the things that don't exist today that existed in 08, because I had quit, Wall Street by then, and I had my own mortgage company, right? I was doing these no income, no asset loans. Basically, the way we were approving loans was like, and we would put a mirror in front of someone's nose, and then if it fogged up, we give him the loan, right? And I'm like, this is going to end so badly. In fact, I remember like today, my best friend was working at Countrywide Mortgage, and I said, I'm shorting Countrywide. I think you guys are going to zero. Because we would do these loans.
I remember the whole Countrywide thing.
We would do all these loans and send it to them, and they would take it. And I'm going like, oh my God, this is going to end very badly. And then sure enough, we know what happened after that with the Bear Stearns and Countrywides and all these, right?
And Lehman.
But I don't think that exists today. Exists today. But
we don't have that kind of stress.
Today we have a bigger problem that I see. So we can talk a few minutes about macro as well, but you started talking about it. Today, my biggest pet peeve, I have 2 kids. Okay. You have 2 kids as well, right? And
I have 2 teenage daughters, and I have an adult son. But he's not in the picture because he moved out. And he's on his own, doing great.
So as parents, right, I talk on my channel quite a bit. And this federal, national deficit that we're running, that's going up $1 trillion every 100 days. And right, the servicing cost which is about $1.2 trillion every year, and it's going to go higher, obviously, because those zero coupon bonds are all expiring or maturing. My thing is like, we can talk about macro and we can talk about the government gaslighting the public here. I feel horrible for my kids, right? Because I go like, why are you guys shackled with this 36, 37, 38, 39, 40 trillion dollars of debt? And that's what I think is the thing that people are not paying attention, because we got to pay the piper on this at some point, so let's talk a little bit about the macro. Do you think the government is gaslighting the public, John?
Absolutely, but they're paid to do this. So I'm not going to call out any names, but you can just. So 2 weeks ago, we had 12 Fed speakers. Last week, we had 14. This week, we have 17.
Yep.
When in your trading history have you ever seen that much Fed speak week after week? I had never had. And, one of them, and I'm not going to name the names because, this is a public channel, but said 3 days ago that the rate cut in September bolstered the housing market. You want to explain to me how it bolstered? The 30-year mortgage is up 50 basis points since September 18th. How did it bolster housing? Then you got Powell, and he's one I will call out because he has said this. He said it at Jackson Hole, and he said it again, that monetary policy has been restrictive. Hello, it's the loosest policy since 2021 in terms of liquidity. You're at all-time highs and everything. It's the everything bubble, if you want to call it that. How in the world can you look America in the face with everything at all-time highs, real estate, gold, all the stock market, and say liquidity is constrained? Hello? But
the ones who know.
Go back to 07, Bernanke was calling soft landing until the second half of 08. And Yellen, who was a Fed president of San Francisco at the time, was saying the same thing. But again, they are public figures, right? They can't say what's really happening because everyone would panic. So it's people like us to have to sift through all this. And by the way, I'll just digress because my 17-year-old is in a financial class right now, which I thought was amazing that her school actually offered this. And I was going to be a substitute teacher next week because the teacher couldn't be there. And my daughter's like, my dad does this. You should bring him in to be a teacher. So I was going to be a substitute. Because I want to teach. I'm a single father of 2 girls. And my son's moved out, but I want them to have knowledge about credit, banking, investing. And so they don't be like me when I was 18, 20, blowing all my money, buying new cars and doing stupid things. But these folks like, these figureheads in the Fed, their job is to maintain order, to keep chaos out of the equation. So naturally, they're going to say these things. They're politicians in a sense. They're what I call economic politicians. They're not really saying what's happening, but if they did, it would cause too much chaos in the markets, and they can't do that. Powell has more power than any human being on this planet. One word out of that man's mouth moves trillions of dollars in a millisecond. Who else can claim that? Nobody. And he knows this. So I think that, to your point, they gaslight. But what if they did come out and say, things are really ... Then the bond market, boom, the stock market, boom. You can't do this.
They can't afford it. The other thing that I keep looking at is that, obviously we'll have the national debt because our budgets are completely blown apart, right? $2, $3, $4 trillion in deficit. I'm going like, and most of the tax receipts that goes into the government are from stock sales. It's not like just to people's W-2s that they're paying into the system, right? They can't afford the market to tank. They just can't. Otherwise, how can Jeff Bezos sell $5 billion worth of stock and pay like a couple of billion in taxes? That's where the money is coming from. So they got to keep this thing up here. But then, market also will make these gaslighters wrong as well. So, we talked a little bit about the macro. Let's not bore people with that. I want to talk to you a little bit about how long. You said you've been trading on and off. You blew an account, all that stuff, which we have all done. But I know now you're not in the corporate world, right? So you're just your sole income is dependent on trading, right?
Correct.
Which is the most difficult thing to do, people. Trust me. When you depend on trading to pay your bills, you got to take your hat off to John because he has survived and he's here, right? Longevity. So how long have you been doing that? Just trading?
I was in a biotech career for 30 years, and then I exited that in May of 2023. So trading was always a side gig. It's easier when it's a side gig, though, because, you just do it when you can, and the stress isn't there because it's just side money, right? But now it is what keeps the lights on, and my daughter's fed. And so that started, so it's been a year and a half-ish, more than that now, full-time trading, which is a different rhythm than when I was doing this as a side gig. It's an entirely different way that you have to prepare yourself, that you have to manage risk, that you have to manage profit and manage yourself. But the first thing I want to say, and I think this is probably the most important thing I'm going to say on this interview, and this is something that I know you see this on X as well because you're active on the platform. that you can be wrong in a prediction of the market and still make money. And you can be right about a prediction in the market and lose money. You see a lot of people on Twitter, I'm sorry, I'm calling it that, who like to do the victory laps because they predicted that SPX was going to hit 5,800 and everyone's posting, yeah, I predicted that 2 weeks ago. Did you make any money? They don't show any trades, but they can do the victory lap. For example, and I'm going to just own up to this. So on October 3rd, I put out a tweet with some analysis that I expected SPY to have a 4% correction starting within about 7 days from that time frame. Why? I went back and looked at 50 years of election data after October 9th. That's the key. What did the S&P do after October 9th, going back to the 1970s before in October of every election? And it had a minimum of a 2.2 or 2.4% decline. The maximum was 20 some odd percent in 08, and 2020 was 9%. So based on all that history, I, with almost a near 100% probability said, okay, by the 9th, we should start having a correction. Didn't happen. But here's what I was sharing also in my tweets. Did I go out and buy 500 or 1,000 contracts of SPY puts on October 3rd? No, we were trading above the 5 DMA. The moving averages were all in a bullish ensemble. I just scalped. 10 contracts here, 50 contracts there, 30 there, holding nothing overnight, just scalping because the price action did not align with my prediction. So I was still wrong. Did we correct 4%? No, we actually made a new high yesterday, but I didn't lose money. Why? Because I did not see the price action align with the prediction. So yeah, the prediction was wrong, flat out. Right. But this is what a lot of traders, and I'm not just talking about X or Twitter or whatever, I'm talking about just in general, forget that it all comes down to profit management, which is not the same thing as risk management. It's, can I still make a profit today? I said, we're going to have this correction. We're making new highs. Okay, scrap that. Don't marry yourself to a thesis. Pivot really quickly. What can I do today? Oh, okay. I think I'm going to buy Oxy calls because it's hitting a 200-day moving average. We've got the saber rattling in the Middle East, and it's at a double bottom at $50. So let's buy some Oxy calls, which is what I did. Those calls went up. I sold at 800%. They went to 1,1600%. This is, I know you've done this. You were trading for professionally. You have to pivot. You have to take your thesis and toss it. You can't marry yourself to it. And a lot of traders, especially new traders, can't do this. They just get stuck in this myopic loop and don't pivot, and they end up blowing out their accounts.
Yeah, that's emotional bias, though, right? I mean, we all have ideas.
Yeah, it's the emotional bias. Now, I still have losing trades. Don't get me wrong. I went long TLT calls 2 days ago. I dumped them today for a loss. I mean, it's not that I don't have losing trades. It's just you can have a prediction. I think the market's going to do this, and it doesn't do it. You can still make money.
Yeah, absolutely. And, since you're talking about it, doing this for a year and a half or so to pay your bills, what type of trader would you call yourself? Would you be like a scalper, day trader, swing trader? What I don't want to label you, obviously,
well, right now, for the last couple of weeks, it's been scalping because we chopped around between 565 and 575 SPY for 3 weeks, pretty much almost like that. So I was just scalping because we're just in the box, moving up and down. Now we broke out of the box. We're above 575. So is it a fake breakout? I don't know. So I'm not really taking any positions because it could be a fake breakout, right? It could just fall back into the box. But typically, I'm a swing trader, holding positions for several days, several weeks, that sort of thing. But there's 3 forms, right? There's investing too. I mean, there's things I would buy and just hold for my daughters when they get married, right? Yeah. But and I don't touch it. I don't trade it. It's just, you just buy it and forget about it. But to make money on a routine basis, it's swing, scalp, and day trading.
Okay. Yeah. I mean,
that's zero DTEs. I do not do any of the zero DTEs.
You don't
stuff.
Do those? No. Yeah, I sell those mostly. I just collect premium.
Yeah, you sell them. I don't touch
99% expire worthless. So
yeah, I will say this. It's kind of funny when I'm a single guy and I haven't been on a date in a long time. But the last time I was on one, the woman says, "What do you do for a living?" And you have to sort of sit there and go, "Okay, if I say I'm a day trader, that's not going to go over well because everybody has this idea what a day trader is." So I said, "I'm an equity analyst." And she's like, "What's that? What's equity? Is equity have to do with people?" Oh, I almost started laughing. I was like, "No, equity is in stocks." Yeah. Oh, you analyze stocks? Do you work on Wall Street? So I'm like, "Hey, this is not going to go." I don't work. So anyway, it's hard to explain to people, Hey, yeah, I'm a day trader. I'm a swing trader. I just sit
Yeah.
in front of charts all day and I buy and sell and I click buttons and I make money that way. Because
Yeah.
people just go, huh? And how do you make money on emotion? I go with the VIX. What's the VIX? I mean, it just leads to lots of funny conversations at dinner parties. I'm
Yeah,
sure
that's
you did
what
the same thing yourself.
when you're on a date like that, though, when you're on a date, your date has no clue about what you're talking about. That's when you have one of your daughters have an emergency call you and that's I gotta go, I gotta run. You know what I mean? But because we talked quite a bit, pretty much on everything I wanted to talk about. So at this stage of my life, right? I do the same thing. I have an investment account that I just been growing and buy and hold basically. And then, every year I start with a certain amount in the same account for the last 20 years. And then I run it without touching it. Don't take the money out. If it's money you need, don't trade with that money. Don't, if it's rent money, don't do it. And so this is the part that I ask all my guests about advice, right? And this could be for beginners, intermediate, and advanced traders as well. So, in closing, I'll give you the floor. Give our audience some advice because they can definitely learn from someone like you, and they learn quite a bit from Anthony. His advice actually was awesome because he had a tweet and he said, it's not making it. We all make it. It's keeping it. you know it's just and so what do you think your advice would be to our audience for traders specifically?
My advice would be twofold. First, when you've done your analysis and you're going to put your money on the line, asking for too many opinions, which could be going on social media, such as a platform like X, where you have all these people who are traders talking and sharing their charts and sharing their analysis, this can result in a bias, a recency bias that just derails your entire trade that you had already planned to do.
Yeah.
And then it goes off the rails. Right. So we have to be really careful about the fact that there's lots of opinions and those opinions can result in analysis paralysis. Right. So that's the first thing is, be careful that you don't fall into that trap because 500 people could have 500 opinions about where NVIDIA is going tomorrow.
Yeah.
And, as a trader, we just can't do this. We have to come up with our own conclusion and put our own money on the line and then manage it from there. But if we're trying to figure out what Joe's doing and Susan's doing and Sam's doing, and and a lot of younger traders are falling into this. They'll go on to Discords, right? And they're trying to figure out what everybody else is doing.
Yeah.
I think that's a real recipe for disaster. The second thing I would say, is, and this is really where, we all know we should have stop losses and basic things like that. But it's being really careful that you know when to let a runner run and when to pull a loser, right? And we tend to do the opposite. We tend to let the loser run, and then as soon as we make 10, 20%, we're pulling it out. When that runner could go a lot more, or we should add to a runner, right? If that runner is just making new highs throughout the day, we should be adding to the position, not taking away from that position. That's a hard discipline. It took me, I'm going to say, 15 or more years to learn how to do that.
Oh, yeah.
So let's say I bought I'll just use a stock as an example, and it's just making new highs all day. Instead of taking my 1,000 shares down to 200 shares, taking the profit, buy more, because it's in a trend, it's trending. It took me a long time to get that habit of when you're trending up, you add to the position. When you're trending down,
a lot of people say stocks are about buying low, selling high, right? Long time ago, and this is even before I retired. And now I'm running my own little hedge fundish kind of a thing, family fund. This is what one of my mentors said, and this is way before algos, way before any of this stuff, right? We used to draw charts like on paper, you know what I mean? And he goes, "You don't buy low, sell high. You buy high and sell higher."
Yeah,
and I'm going like,
exactly.
What does that mean? That like put the light bulb, and I'm like, wait a minute. So perfect example would be a stock like NVIDIA, right? Stock has done nothing but, yes, it had some monstrous pullbacks, but it has done nothing but higher highs, higher lows, right? So just follow the trend. Trend is your friend. And but a lot of people, try to dissect all that. I think, oh, this must be the top, this must be the bottom. You don't need to do any of that. But yeah, so I appreciate you coming on. I know I took a little bit more time
Sergio.
than I needed to, but So we will definitely keep, seeing each other on X, and I will join your space. So John is at market_sleuth on X.
Yeah.
Please go follow him. And he has some wisdom that he's shared with you all, and that's priceless to me. So I appreciate you coming on. You stay healthy, nothing but profits. So we'll keep in touch.
Thank you, Sergio. It was a pleasure.